Hi, welcome back to my YouTube channel. Topic that we will have a look at today is bullet versus barbell strategies, which is basically used in bond portfolio management, and it is from paper 4, that is valuation and risk models. So let's have a look. Before we start, I will request you to please do subscribe to my channel, share my videos with your friends as well, so that they also get benefited out of it. And believe me, it takes a lot of time and efforts to come up with quality videos like this. So if you can share with your friends, it would be really helpful for us to reach out to maximum audience. So let's have a look at the strategy. So, these are you might be aware that in our school times, picture used to make our studies interesting. So, just to highlight it, I have kept two pictures over here, which are somewhat relevant to the topic that we are having a look at today. So, one is bullet and other one is barbell. So let's see what this strategy actually means, and then we will have a look at one of the numerical on this topic. And I will tell you two very key important points from the exam point of view at the end of the video after we solve the numerical, because those key points will come out of the numerical solving. So stay till end so that the key point that I'll be sharing may be useful for you in the exam. So the a bullet investment is used when an investor buys a single bond, typically concentrated in the intermediary maturity. So, say for example, let me go to another slide. I can explain it in a better manner. So, say for example, you have got three bonds, and it these are ordered in the uh, ascending order of the maturities. So, the one with the maturity in the middle, if investor is investing in this particular, let me highlight it with a color. So invest if investor is investing in this particular bond, which is between 4 year and approximately 29 years, then this is called as a bullet strategy. And if investor is investing in these two, first and last one, then it is called as a barbell strategy. We'll see at the end that the key points that I just told you that I'll be sharing, we'll see what is the motivation of the investor investing in the bullet or barbell. So, wh- which kind of investor would like to invest in the barbell strategy, and which kind of investor would like to invest in the bullet strategy? So, once we solve this numerical, that would be very clear to you. So, this was just an explanation that bullet pertains to the investment pertaining to the maturity, which is intermediary, and barbell pertains to the investment, which is investing in short and long end maturities and not in foregoing the intermediate. Let me highlight it so that these you have underlined the keywords, but this is also important. So in barbell, you don't investor doesn't invest in the intermediate maturities. So hope it's clear now. Let's have a look at the numerical. So you have been given three bonds, and you have been asked that, assuming that you have been given that, assume that you are going for barbell portfolio. So what is the percentage of allocation that you would invest in a short and long term bonds? So given is barbell strategy. So we will invest in this bond and this bond, that is short end bond and long end bond. So you have been asked that what percentage of your investment you will make in your short term bond, and like there are options, so we will choose accordingly. So 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 let's have a look how we can solve. So first of all, you have to keep in mind whenever you're building a portfolio, you have to bear in mind that that duration of the portfolio has to be equal to the intermediate. I'll tell you at the end why. So the method to solve this is, say for example, let's call, let me go to the next slide, that's blank. So I have kept it for solving. So say for example, weight of the short-end bond is WS and weight of long-end bond is WL. So whatever this WS would be, and remaining that we will invest in the long end. So WL eventually intuitively also it is 1 minus WS. So now what you have to do, you have to create a portfolio which has the duration equal to 8.033. So W, so let me write the mathematical equation. You would be able to mimic WS times this into 1 minus WS, that is whatever portion you already invested. Remaining we will invest in the duration of this bond, which be equal to 8.033. So let's see, let me write the equation and solve it for you. So what you will do, you will have the duration of first short-end bond as 4.51, 4.52, sorry, into W1 plus you are creating a portfolio, so plus, so let me make it the precisely WS. So, and 1 minus WS, you will invest in a long end bond whose duration is 16.611, and that should be equal to the duration of the intermediate bond, which is equal to 8.003. So let's solve it quickly, then I'll tell you one interpretation. So 4.52 times WS plus 16.611 minus 16.611 WS. I just multiplied this 16.11, this bracket, equal to 8.033. Let's solve it, and let me bring this 8.033 here, and this minus bigger number. It's same. I mean, even whatever, in whichever way you want to do it. So let me do it. Let me keep 16 point this term over here and bring this 8.033 on the left hand side, minus, I'll shift these two terms on the right hand side. So this minus term will become plus 16.611 WS minus 4.52 WS. That is weight of short end bond. So if you do this subtraction, you will get 8.578 equal to 12.091 WS. So let's shift this term in this side denominator. 8.578 divided by 12.091 equal to your WS. So if you divide this, you will get approximately WS equal to 70.94. That is percent, 0.7094. So I have written it as 70.94%. So if I go to previous slide, your answer is, so it's a WS. So in short term, you will buy 70% of your investment amount in the short term maturity, and remaining you will buy in a long term maturity. So correct answer for this is A. Let me write it. Let me mark it in a green. So your A is your correct option. And the key point that I told you that I'll tell you at the end of numerical are, if you spot, so So there are two important points which you can note down. So barbell has a higher convexity than bullet, hence less risk from interest rate perspective. So I'll explain this point in detail. And higher convexity comes at the cost of lower yield. So what you can do is, let me explain, because in text term it may not be clear. So if you go back, so if this is a WS, then your WL would be equal to 100 minus 70.94, which would be approximately 29.06. So total is 100. So now you have got your weights. What you can do is you can multiply these weights and find the corresponding convexity of this portfolio. So instead of so what you can do, you can multiply 70% of this and approximately 30% of this. You will get way higher convexity than this term. So you can imagine 30% of this and 70%. 30% of this number only very much higher than, so say for example it is approximately 39. So if I take 30% of that, let's take it to 40% approximately. So 120 from this long end investment only will come, and 70% of this. So it would be much higher than convexity of the bullet portfolio. So when I say convexity, let me tell you what exactly I mean. So if you are a bond investor, so let me plot a bond payoff. So some bond payoff is somewhat like this. It's say, so this is your interest rate and this is your price. So when we say convexity is high, the curvature degree of this payoff will be higher. So when I say convexity is higher, so when there are interest rate movements in the market, so when your price goes when your interest rate goes down, your price will move by a very good amount. At the same time, when your interest rate goes up, your price will fall down by a lower rate. So when you are in a profitable situation, you are in a more profitable situation, and when you are in a loss situation, your loss is little lesser when you have a higher convexity. So if I were to say you, what you will do, if 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 some investor is coming to you and his risk profile is little conservative, then barbell strategy would be beneficial for the risk conservative investors. So barbell is for an investor who is slightly risk averse. So risk appetite is less. So this, because of this higher convexity, his risk awareness will be taken care of. But at the same time, when you have a less risk, your returns also go down. So if you go back to previous slide, and if you calculate the yield of the portfolio, so ideally, I mean, if someone is investing in a bullet portfolio, so he may get a yield of approximately 3.3%. But with a 70% investment in this and 30% investment in this, your yield will be much lower than what you will get in a bullet. So the suitability for a bullet, so bullet one who will go in a bullet will be a little investor who will expect higher return. Bullet is a for an investor who expects higher return. So these are the points, because in exam this is a very straightforward calculation. So that may not be tested, but yeah, this is a key learning outcome from this, wherein your understanding can be tested. So barbell is a for an investor who is a risk averse, because you have a higher convexity in the barbell strategy, and bullet is a for an investor who expects higher return. Hope you like the video. If yes, please do share with your other students as well, so that they also get benefited out of it. Thank you for staying till the end of the video. Stay connected with the channel. Thank you.